All right, we're going to go ahead and get started with today's webinar. Thank you again for joining us. Today's topic is potential impact to your business, individual tax reform highlights under the Tax Cuts and Jobs Act. My name is Rachel Daly. I'm the marketing director here at Richey May. Just want to thank everybody for joining on behalf of all of us here at the firm. A few housekeeping items before we get started. Just so you're aware, all participants are on mute. You do have the opportunity to answer or to ask questions during the presentation. If you look at your webinar dashboard, there is a section for you to type in those questions, and we will be receiving those throughout the webinar. It's unlikely we will have time to address those questions at the end of the webinar. We do have quite a bit of content to go through, but please do note that we will gather those questions and compile them along with answers, and we will get those out to the entire participant group so that you can all see the questions that were answered or asked and the answers to those questions. So please do look for those in the next few days. Also note that a recording of today's webinar and the copy of the slide deck will be emailed to everybody on today's webinar. So please do look for that. That will either be later this afternoon or tomorrow. Just quickly, just disclaimer, this will be included in the webinar materials in the slide deck that you do receive, so you're aware of that. And now moving on to CPE. I know many of you are looking to qualify for CPE today for 1 hour. Please note that you must answer all 3 poll questions that are spaced throughout today's webinar. You do not have to answer them correctly, but please do submit an answer to those poll questions. Just another note, we cannot honor group responses as qualification for individual CPE credit, so you must be logged in individually to today's webinar and answer those poll questions to qualify. A survey will also appear on your screen at the close of today's webinar. Whether you're looking to qualify for CPE or not, we would appreciate if you would fill out that survey and give us your thoughts on today's content. Those who do qualify for CPE credit, certificates of completion will be emailed to those individuals in the coming days after today's webinar. Please do give us a little bit of time. It takes some time for us to pull those together, but those will be going out in the next several days. With that, I'm going to go ahead and introduce today's presenters. We have 2 of our senior managers here at Richey May presenting today. First off will be Jake Lawrence. He's a senior tax manager here at the firm. He'll be followed by Kaylin Richey. He's a senior manager in our business advisory practice. Both presenters serve clients in our mortgage banking industry and have a lot of expertise, obviously, in that area. And today they're going to walk us through the individual provisions in the Tax Reform Act that may impact your future business decisions. So with that, I'm going to go ahead and turn it over to Jake to get started.
Good afternoon, everybody. We certainly, again, appreciate you joining us for this webinar. I think our goal today, Caitlin and I's goal today will be to just walk you through some of the highlights or some of the, I guess, more important individual provisions from the latest Tax Reform Act that could, or we believe may impact your business. So as you can see, the agenda and kind of the topics we're going to try to get to today and address are certainly the mortgage interest deduction, some of the other individual provisions that were passed in the Act, loss of miscellaneous itemized deductions, compensation concerns, and then certainly we'll try to wrap a bow on all of this and discuss some of the potential impacts to the lending and housing market. So that's kind of our goal today, where we're headed, and so we'll jump right in with the first topic here of the mortgage interest deduction. So I think in order to help us better understand the impact that the changes in this area had, I wanted to just define a couple terms up front and work from there as we'll be using or referencing these definitions kind of throughout the presentation. So one of the terms that comes up frequently when you're talking about the mortgage interest deduction is this idea of acquisition indebtedness, and the IRS code has defined that as any indebtedness which is incurred in acquiring, constructing, or substantially improving any qualified residence of the taxpayer and is secured by such residence. And then the other definition that we see throughout the code in regards to this area is what we call home equity indebtedness. And they've just defined this very broadly, which is basically any indebtedness other than acquisition indebtedness secured by a qualified residence. So we'll make reference again to these two definitions kind of throughout the presentation. So just as a reminder, under the pre-act law, the old rule in regards to mortgage interest deductions were as follows. A taxpayer could deduct as an itemized deduction qualified residence interest, which includes interest paid on a mortgage secured by a principal residence or a second residence. And more particularly, that meant that the interest deduction was limited to the amount attributable to no more than $1 million of acquisition indebtedness for those that were married filing jointly, or $500,000 for those that were either single or married filing separately, plus the interest on no more than $100,000 of home equity indebtedness. And again, that was reduced to $50,000 for those that were filing a single return or a married filing separately. So under the old law, there was this $1 million cap plus $100,000 of what we've defined as home equity indebtedness. Under the Tax Reform Act, they certainly have changed what it qualifies or what's deductible. So under the new act, for tax years beginning after December 15th, 2017 and before January 1st, 2026, taxpayer can deduct as an itemized deduction qualified residence interest, which includes interest paid on a mortgage secured by a principal residence or second residence. So again, not much change as to what qualifies as qualified residence interest, but where they've put the limits in is on the amount that's deductible. So the interest deduction is now limited to the amount attributable to no more than $750,000 of acquisition indebtedness for those that are married filing jointly, or $375,000 for those that are single or married filing separately. And as you'll note there's no longer any provisions to allow any interest deduction for interest on home equity indebtedness. They've completely eliminated that the ability to claim as a mortgage interest deduction any interest that meets that definition that we went over at the beginning. So also under the new Tax Reform Act, there are a couple of, they included a couple grandfather exceptions regarding some of the mortgages that may have been in place prior to that December 15th, 2017 cutoff. So the first of these exceptions is debt incurred before December 15th, 2017 is not affected by the reduction in mortgage loan amount, and therefore the limits are still $1 million for married filing jointly, $500,000 for married filing separately. So if your mortgage was in place and everything was squared away prior to that date, but the amount was over that $750,000 threshold, you're grandfathered in and still would get to take an interest deduction on amounts up to $1 million. Under the second grandfather exception, it mentions that debt incurred before December 15th, 2017, but refinanced later, continues to be covered by the pre-act law to the extent the amount of the refinance debt does not exceed the amount of original acquisition debt being refinanced, basically meaning the remaining principal amount of amortized balance of the acquisition indebtedness. So essentially, you're still allowed to take as a deduction, as a mortgage interest deduction, the amounts up to the amount of the debt that you had prior to that refinancing, and then as you refinance or any amount that's refinanced over that threshold, $750,000 threshold now, or over the threshold that you had originally had a mortgage note on, is now no longer deductible. We'll go through several examples to kind of walk through the numbers on this to hopefully shed some light on these exceptions, make them hopefully make a little more sense. Certainly the grandfather rules are tricky. There's some other provisions that we aren't going to cover today regarding the grandfather exception that get into some details regarding these refinance provisions and some of the refinancing that borrowers could do. Those rules get fairly complicated, and I don't think we'll have the time today to cover those. So just note that there are some additional rules regarding this grandfather exception. So just just recently, so I don't know, within probably the last month or so, the IRS has come out with a few examples to kind of walk through the mortgage interest deduction provisions. And so we're going to walk through kind of the three illustrations that they've provided, and then there's a couple others that we'll go through that have arisen from specific questions that we received as a firm in this area that hopefully we can, as we highlight on this, we'll again try to just provide some clarity on the additional or the new rules under the Tax Reform Act. So the first example here, and to make sure I don't misspeak, I'm just going to kind of go through the illustration here on the slide. But in January 2018, John takes out a $500,000 mortgage to purchase a main home with a fair market value of $800,000. In February 2018, he takes out a $250,000 home equity loan to put an addition on the main home. Both loans are secured by the main home, and the total does not exceed the cost of the home. Because the total amount of both loans does not exceed $750,000, all the interest paid on the loans is deductible. And then they go on to note there, however, if John used the home equity loan proceeds for personal expenses, such as paying off student loans, credit card debt, to purchase an RV or go on a family vacation, etc., then the interest on the home equity loan would not be deductible. So again, what they're really looking at here is whether it's a second mortgage, a HELOC, the key is that money needs to be used, as the definition states, for acquiring, constructing, or substantially improving a principal residence or a residence that qualifies under the definition. So in this case, since the $500,000 first note and the $250,000 home equity loan both are under the $750,000 threshold and are all used for acquiring, constructing, or substantially improving the principal residence, all that interest is deductible. So going to illustration number 2, similar facts, but slightly different, some slightly different changes here. In January of 2018, Mary takes out a $500,000 mortgage to purchase a principal home. The loan is secured by that principal residence. And then in February of 2018, she takes out an additional $250,000 loan to purchase a vacation home. That second loan is secured by the vacation home. So it's noted here that because the total amount of both mortgages, again, does not exceed the $750,000, all of the interest paid on both mortgages is deductible. However, we wanted to note, or the illustration notes that if Mary took out the $250,000 home equity loan on the main home, purchased the vacation home, then the interest on the home equity loan would not be deductible. And again, that goes back to those definitions that she used that home equity loan to purchase a second home that wasn't secured by that property. So again, the reason why it works in the first part of this example is because the $250,000 loan she took out, she secured with the vacation home she was purchasing, versus the second example, she takes it out on the primary residence to purchase the second residence. And so there's a slight distinction there between those two and what the home equity loan was used for. And then finally, on the third illustration, this one states that in January 2018, Bob takes out a $500,000 mortgage to purchase a main home. The loan is secured by the main home. Again, in February, he takes out a $500,000 loan to purchase a vacation home. The loan is secured by that vacation home. But here, because the total amount of both mortgages exceeds the $750,000 limit, not all of the interest paid on both mortgages is deductible. So in that case, only a percentage of the total interest paid is deductible. And then again, that's because now you've exceeded that $750,000 limit with the amount of debt that you have outstanding. And again, as we've initially had our first webinar, we've received several inquiries and questions regarding this particular area. We know there's a lot of questions involving this, and so what we want to do is just cover a couple of questions that we've received in regards to this area, hopefully again provide some or shed some light on this. So one of the questions that we received is, if a borrower had a first mortgage and a HELOC prior to 12/15/17, would all the interest still be deductible under the new Tax Reform Act, just as it had been under the old law? And so the answer to this question is, if the HELOC was in place prior to the 12/15/17 date, And the HELOC was used to acquire, construct, or substantially improve a qualified residence and was secured by that same residence, and in conjunction with the first mortgage did not exceed the $1 million limit that was then in place, then yes, the interest would also be deductible going forward under those grandfather rules that we talked about, since at this point the HELOC would meet the definition of home acquisition indebtedness. And so just to note here that if the HELOC, even if in place before the 12/15/17 date was used to purchase a boat, pay off loans, used for anything other than acquiring, constructing, or substantially improving the residence, then starting with the 2018 tax year, any interest on the HELOC would not be deductible going forward. So you'd still get the benefit of mortgage interest deduction on the primary mortgage, but nothing going forward on the HELOC, as it wouldn't meet or fall under the grandfather rules. The second question that we received in this area that we wanted to kind of shed some light on was, would the timing of the origination of a second mortgage, either at closing or a subsequent refinance, determine if the corresponding interest is deductible? And so just to kind of provide some clarity here, in regards to this particular question, there's a difference between a subsequent origination of a second mortgage, second lien position, HELOC, and a subsequent refinancing. So in regards to the subsequent origination, our thought here is that even if this occurs 1 month or 5 years after the primary mortgage origination, the interest could be deductible if this subsequent origination is used for acquiring, constructing, or substantially improving a qualified residence and is secured by that residence. So essentially, again, we got to meet that definition of home acquisition indebtedness. Since this would, by doing so, this would disqualify this second mortgage from being swept into the definition of home equity indebtedness. And so then again, just to note here, how much of this subsequent origination would be deductible would depend on the use of a formula that the IRS has put into the Tax Reform Act and into the tax code. And so I won't go through all the calculations, but that particular, those details will be in the slides that are sent out later. Now, in regards to the subsequent refinancing, the new rules state that any refinancing that takes place after December 15th, 2017 will be grandfathered in under the old $1 million limit as long as the amount refinanced does not exceed the amount of original acquisition debt being refinanced. So, or in essence, if the original note was for $950,000 and in place before 12/15/17, and the borrower subsequently refinances after 12/15/17, but does not refinance for more than the principal amount remaining on the original acquisition debt, i.e., $875,000. If there was $875,000 of principal remaining, then they would still be able to take mortgage interest deductions on the remaining $875,000, even though this is in excess of the $750,000 limit. So again, it looks at how the refinancing takes place and again whether or not that's and how that corresponds to the original acquisition debt. Now, to kind of follow up on that, if the refinance amount exceeds the principal amount remaining on the original acquisition debt, so again, if our refinance amount is $975,000 and the principal amount remaining on the original acquisition debt is $875,000, then the borrower would only get the grandfather privilege on the $875,000 and will get no interest deduction on the additional $100,000 since at the point of the refinance, they were already over the $750,000 of acquisition debt limit. So again, this will be in the slides that we send out, and the numbers will be there. But again, I think the thing to remember with all of this is it's all about making sure that the second mortgage, the HELOC, second lien position, whatever you want to call it, meets that definition of acquisition indebtedness, that it's used to acquire, construct, or substantially improve the residence. And then you certainly have to be aware of the debt limits. So is that second going to push them over the $750,000 limit on an acquisition or an original, a second mortgage that's originated? And then certainly in the area of refinances, the rules are a little trickier there as we kind of walk through on that example. And so you just really have to be thoughtful about how much the refinance is for, and again, what that's going to be used for. So certainly we recognize and realize there's going to be additional questions in this area, so feel free to reach out to us. We'd be happy to walk you through any questions that you have in regards to the mortgage interest deduction. We realize that this is a big part or a big piece of this Tax Reform Act that is impacting borrowers and could impact their thoughts about buying a home, buying a second home, buying a vacation home, or refinancing the current home that they have. And so we certainly are aware that, and are expecting lots of questions in this area. So moving on to just a couple thoughts in regards to mortgage interest deductions, but in regards to kind of the 1098 interest statement thoughts. So we know we've gotten some questions in this area as well. And so we just wanted to share a couple thoughts in regards to 1098 interest statements. Just as kind of a reminder, the lender has the responsibility to report all interest related to first mortgages, second lien positions, and HELOCs, et cetera, on the borrower's 1098 interest statement. And so typically on the face of the 1098, that's what you're going to see is that entire interest number that you're going to report. And so, what's typically not evident is what type of interest is included in the total shown. And just to kind of remind you as lenders, it's not your responsibility to differentiate what type of debt the interest relates to. That responsibility falls directly on the borrower. And so as you can see from bullet point 3, our thought here is the borrower has the responsibility to determine what portion, if any, of the interest reported on the 1098 is deductible in their personal tax return. So really the borrower is the one that's going to know what they used that second mortgage for, what they used the HELOC for. And so again, it's their responsibility to determine if that wasn't used for the acquisition, construction, or substantial improvement of a qualifying residence, then in theory that the interest related to that is not deductible. And so, but again, as a lender, your responsibility is to put all of the interest on the face of the 1098, and it's the borrower's responsibility to determine what portion of that is truly deductible in their individual or personal return. A couple other of miscellaneous thoughts here is we certainly know there's been some back and forth on mortgage insurance premiums. And under the budget reconciliation bill that was passed in early February, there were several tax provisions that were extended, including the deductibility of MIP by borrowers. So I know originally as 1098s were being issued, that mortgage insurance premium amount was not included on those 1098s. And now that this bill has passed, I'm sure you're getting questions from borrowers about the deductibility of that MIP or what was that amount that they paid. And so just to kind of note here, due to 1098s having to be issued by the end of January, per the 1098 instructions at the time, MIP was not included on the forms that were sent to borrowers. But however, with the extender bill passed, the IRS has since instructed lenders to issue corrected 1098s to include the MIP amount borrowers are now allowed to deduct for 2017 tax return purposes. So if you are getting questions about the deductibility of MIP, it is certainly deductible now. And so corrected 1098s can and should be issued to provide that information to borrowers as to what mortgage insurance premium amount is deductible in their return. So those are just a couple other kind of miscellaneous items and things related to or indirectly related to the mortgage interest deduction that we wanted to point out and just kind of make you aware of as we go through this presentation today. So I think at this point, we're going to jump into our first poll question. So we'll let you take a minute or so to answer that. All righty, hopefully everybody had 30 seconds to a minute there to answer that question. kind of shifting gears a little bit, we wanted to just talk a little bit about some of the individual provisions that were adjusted or changed or modified with the Tax Reform Act. And so some of this, it's going to be very high level, but we felt it was important to just point out so that you guys were aware as lenders of some of the things that borrowers could be thinking about as they are hoping to borrow or purchase a home. And some of this was covered in our first webinar back in January, but we wanted to, again, just kind of refresh your memories on some of this. So very high level, the tax rate for individuals changed under the new Tax Reform Act. And so you can kind of see here the old rates versus the new rates. And so we just wanted to point that out here. We're not going to spend much time talking through those actual percentages or numbers. You see them up here on the screen. They'll be in the slide presentation, but just remind you that there certainly could be some impact to people's financial positions based on the fact that their individual tax rates changed slightly. Here again is just a reminder of kind of some of the high-level changes between the prior law and the new tax law, and how they could impact individuals. As you can see here, the child tax credit, the amount has increased under the new Tax Reform Act. Again, we just talked about individual tax rates decreasing for some brackets. Certainly one of the big items we wanted to note that we'll talk about a little later in the presentation that we think could impact borrowers' decision making is the changes to the standard deduction and just the significant increase to those deductions that could impact borrowers' decisions to itemize deductions in their individual tax returns. Certainly the corporate rate, pass-through income, there was changes there that we've covered on a previous webinar. The other big piece is there's no longer personal exemptions. Those have been repealed under the new Tax Act. And then the other one that we'll talk about here for a few minutes is the impact to the deductibility of state and local taxes paid. They significantly changed those. And then obviously the one that we just talked about, which is the mortgage interest deduction and the changes to that. So we'll jump into talking a little bit about the state and local income tax and property tax limitations. So certainly for those borrowers that were itemizing and potentially had high property or in high property tax states, this change could impact them significantly. So in summary, for tax years beginning after 12/31/17 and before January 1st, I think that should actually be 2026, not 2016. Itemized deductions for state and local income taxes, state and local property taxes, and sales taxes are limited to $10,000 for those folks that are married filing jointly and $5,000 for those that are married filing separately, and that's in the aggregate. So you get, basically, you're limited to $10,000 of deductions from any combination of state and local income taxes, property taxes, or if you choose to do sales taxes. And so, again, this was one of those items that people typically got a benefit from when they itemized, depending on the state they lived in and the amount of property tax or income tax they paid. And again, we'll discuss this a little bit more and kind of the impact a little bit later on in the presentation, but just wanted to remind you that this cap, this limit is now in place and certainly can affect the thinking of borrowers as they're looking to purchase homes. Just one item to note here, this cap does not apply if these taxes are incurred in the carrying on of trade or business or otherwise incurred for the production of income. And so certainly examples here, rental or Schedule C business property taxes are certainly deductible in relation to that business or that business endeavor. Again, as we mentioned in that kind of overview slide, that comparison slide, the standard deduction has increased. So for those that are married filing jointly, that has is almost doubled, going up to $24,000, $18,000 for head of household filers, and $12,000 for all their individuals. So again, that significantly could change the thinking around whether you're going to itemize in your tax return or if you're just going to take the standard deduction. And certainly we'll talk a little bit more about the impact of the mortgage interest deduction as well as the state and local income and property tax limitation that could affect this thinking. It was noted in some of our research and some of the articles that we've read that prior to the Tax Reform Act, and depending on, like I say, which website or which article or which group you're reading, these numbers could change or be slightly differently, but roughly 30% of individual filers itemized their tax deductions, and it's anticipated under the Tax Reform Act that number will significantly decrease. And like I say, kind of the averages we've seen is it could reduce all the way down to about 10% of individual filers will itemize. And so again, the idea here is that this increase was, the reason for the change in the standard deduction and everything that we've read is the motivation was to simplify the tax return filing process for individuals. And so certainly by doubling that standard deduction, you're inherently decreasing the number of folks that will itemize and go to this simpler tax filing methodology. So just something to think about with the standard deduction. Just real quickly, we'll go through here and then we'll let Kaylin jump in and kind of talk about some additional areas here. But here, many of the itemized deductions and above the line deductions under the Tax Reform Act were either eliminated, limited, or modified. And so here we've just provided kind of a list of those itemized deductions that were impacted. Certainly, as you can note here, ones that were limited were the home mortgage interest that we've previously talked about, and also the state and local income tax deduction that are now limited. And then certainly some of the other big areas they've modified or completely done away with. So one of the big areas that they've eliminated entirely are the miscellaneous itemized deductions subject to that 2% floor. And Kaylin will spend just a couple minutes talking about that, kind of the impact that may have on borrowers. Just one thing we wanted to note here that all of these eliminated, limited, or modified provisions are set to expire for tax years beginning after 2025, assuming that no additional tax legislation is passed or tacked on to the end of that to extend these changes. So, and then lastly, just a quick list of those above the line deductions that were changed or eliminated or modified. We won't go into the details here, but just certainly want to provide that list of, again, all of these things in whole, we feel could impact borrowers' thinking as to, whether or not they want to be, whether they're first home buyers or purchasing a second home or refinancing. We feel like a lot of these individual provisions may impact some of their thinking and what their thoughts are in regards to purchasing a home or borrowing. So we provided a couple quick kind of graphs here to kind of show you the impact, and Kaylin will jump in and kind of follow up on this. As you can see, this information was from the IRS, but the latest information that we could kind of gather was from 2014. But you can kind of see from this graph by income bracket as to kind of who was more likely to itemize versus use a standard deduction. Clearly, you can see that as the family or household income rises, more and more folks were itemizing. And so certainly we think there could be an impact of that standard deduction increasing significantly. And now on this next slide, you can kind of see, just of those folks that were itemizing, you can kind of see of what the amount was by filing type as to what the itemized deductions, their expenses they were taking, what made up those deductions. So here you can see that the taxes paid that we talked about that are now limited to $10,000 made up a significant piece. Mortgage interest was probably the next highest piece, and then obviously charitables and all the other standard deductions made up the rest. But clearly we think that those limitations to that $10,000 amount and the mortgage interest deductions could change certainly, the thinking behind itemizing and taking those deductions versus the standard deduction.
With that, we'll launch CP poll question number 2. Take a minute. We'll gather responses up and come back on momentarily. All right. All right, I kind of wanted to start out my piece of this by just kind of showing a tax form to many of you, most of you probably. This is, ugly or not desirable to look at right now, but I think it does kind of summarize all of those things Jake was mentioning, or most of them anyway, all of those below the line deductions that were contained up in the slides up above. This is an image of a Schedule A tax form that is included in all 1040s when it's determined that a individual taxpayer is more beneficial by itemizing all those deductions over using the standard deduction. Again, virtually all the changes we talked about thus far are this is where they materialize and become apparent to the tax filer, potentially for the first time this year, after the tax reform. This might be a schedule that individual tax filers pay attention to a lot more, because it'll be one that where they'll start to see that all these things they thought they might be getting deductions for, they might not provide any benefit. So kind of just walking down the left side there, don't worry about all the content included in the middle. The highlighted, bolded section titles on the left are kind of what I want to draw your attention to. Medical and dental expenses remain virtually unchanged under tax reform. That second section there, Jake mentioned, that's where all the accumulation of state and local type of taxes used to be aggregated together and then usually just foot over to the deductible column on the far right. That now in 2018 is going to get capped at $10,000. Notably, Jake's information included this, but there's I think somewhat of an inadvertent marriage penalty there, because it's $10,000. It's a $10,000 cap where you file an individual return or a married return filing jointly. Usually, individual thresholds are doubled when you move on to a married tax filer that's filing jointly, but in this case, not true. The next section there is, I think, the milestone of this presentation, and that's where all the mortgage interest used to get accumulated. It still will be there. I don't know if this will be the exact presentation, but the only nuance is that the $750,000 home acquisition indebtedness cap now has to be implemented. It'll be done so off this page, I assume, but that will look virtually the same. Gifts to charity look virtually the same. The only change in the act was actually positive. There's more availability for charitable deductions, actually. And then just underneath charitable contributions, we get to casualty and theft losses. This virtually goes away for most people. They'll still leave it in here, though, because the IRS is still going to allow for deductions of casualty losses if you lost property in a federally declared disaster area. So what I want to spend some time on is the big, ominous red box there with a line through it. That is a summary, actually, of another tax form that I'm not going to bore you with, Form 2106. So the 2106 is another page-long form where an employee can walk through all of their unreimbursed business job-related expenses and sum them all up, and then they're brought over to this page. Well, all of those are gone. So big section of this Schedule A and itemized deduction no longer applies and no longer offers any benefit. So kind of just going back, you foot over all of these things that will remain to that far right column there, and it all sums up to the bottom line. And if that bottom line in 2018 does not exceed $12,000 for singles, $24,000 for married filing jointly, these deductions aren't going to provide any benefit to an individual. So diving in to those, basically this is a slide that shows it's directly related to that big red box on the Schedule A. These are the things that are lost by those items no longer being deductible. So who's kind of directly impacted by all these things going away? It says employees tracking their unreimbursed job-related expenses. These are usually, especially in this industry, the mortgage industry, salespeople would make up the largest percentage probably using this. LOs. There might be some of your marketing and promotional employees that maybe they travel around and represent you at trade shows or real estate partnership events or something of the like. They might be traveling. A lot of these relate to kind of travel and entertainment and dining type expenses. So basically, if any of the items listed there are incurred in connection with something you're doing on the job and you don't seek reimbursement for it, then the government used to help you out by subsidizing some of those expenses, giving you a deduction on your tax return form. Those are no longer available. So in addition to one's capacity as an employee, you could also include a number of deductions in that miscellaneous section, whether or not you were an employee. So those items are listed there. Investment type expenses. These are some of the more common ones and not all encompassing. Investment expenses, like your advisor fees, your money manager fees, tax prep fees, legal fees to defend in any IRS matters. And I won't spend a lot of time going through all those, but those are there as well. So who is indirectly impacted by these changes? Well, if employees are directly impacted, you can bet that there's going to be some friction and some concern passed up the chain to those in charge of their employment. So employers are certainly indirectly impacted. Whether or not a company as an employer has an accountable plan, accountable reimbursement plan, that is, employees are going to be much more likely to seek reimbursement after the Tax Cuts and Jobs Act is passed. Again, now that the government isn't helping out, they're not going to want to come out of pocket and have zero help. So the next place to turn is their employer. So while some of these expenses can be reimbursed, and there might be a meeting of the minds between an employer and an employee, a lot easier with things like deductible expenses. So all that travel stuff that was mentioned, lodging and airline tickets and parking fees, those items would be deductible if the employer decided to reimburse them to the employee. But there's an interesting nuance if the employee starts asking for things that wouldn't be deductible to the employer either. So you can imagine the conversation happening something like a salesman comes to executive and says, I no longer get to deduct these on my tax return, and I have to pay them out of pocket right now. So I'm going to either stop doing that and have you pay for them, or please work with me to reimburse me. And the employer says, well, that doesn't make sense to me to reimburse you for these, because it's not like I get a deduction either on the company return. So those types of items are listed there. Entertainment, this is going back to some of the items covered in the business webinar that we put on. But these items are kind of not deductible items anymore within a business. Entertainment became fully non-deductible under the Act. Business meals has always been 50% there, but certainly something to consider if employees are coming to you now for reimbursement on those. Another change was the meals provided for the employer's convenience. So things like, on-site premises meals prepared, in a cafeteria setting, or meals ordered in for the convenience of the employer to the office. There's a big change there. Those used to be 100% deductible as de minimis fringe benefits. Now going to be 50% deductible through 2025, and thereafter not deductible at all. So again, you can start to just picture some of the friction that could come up with regards to this. And this is going to happen, I guess, with your borrower base as they're employed, but also within your own organizations, your own employees might be thinking these same things. So as soon as you start talking about reimbursement plans, it's almost inseparable, right, from compensation. So you can't start talking about reimbursement and not have it lead right into, well, how do we maybe marry these types of things with adjusting comp? So while the Act itself, the Tax Cuts and Jobs Act itself, didn't make any significant changes to comp and the deductibility of comp for private businesses, the changes that it made on the individual side are certainly going to lead to more discussions about compensation. So we just want to cover some of those potential impacts here quickly. Nothing groundbreaking here. Obviously, I don't have to tell you this. Preaching the choir. Talent acquisition out there is extremely competitive, and due to the competitive nature to try to acquire talent, whether it's from the company side, lenders, company side, or from the employees, the salespeople, the branches themselves, creative compensation structures are kind of popping up. How are you going to differentiate yourself from ABC Mortgage Company down the street? Maybe one of the areas to start getting creative with compensation. So, we just wanted to point out and remind people some of the issues with getting creative with compensation. And this has nothing, we're going to stay away from Reg Z and Dodd-Frank. We'll let lawyers cover that. As CPAs, kind of issues we're concerned about are ones that might not pass muster with the IRS. So going down that list there, complex commission formulas, when you start, typical example is loan amount times a percentage is a kind of a starting point for a commission formula. And then maybe in 2017, you allocated expenses A, B, and C to reduce that commission. Well, now knowing that employees might be coming and asking for a few more expenses to be reimbursed, maybe they're asking for the formula to now include expenses A, B, C, D, and E, etc. So the IRS doesn't like this, obviously, because what you're doing is taking deductions from the company's return on different line items as different categories, and basically reducing your employees' compensation. They clearly don't like this because you avoid your base, I guess, included in your wage reporting is lower in that sense, and so you're not remitting quarterly as much quarterly wage withholding and all the taxes that are attached to wages. So moving down the list, expense reimbursements that the IRS would view as taxable wages. This is the flip side. It's not netting down wages. This is expense reimbursements that would increase wages. So one actually that did come as a change that Jake had up in one of his slides was a above the line deduction for moving expenses. I think it's an easy conclusion to maybe connect the dots that in these higher property tax states that you hear about, New York and California and Illinois, and where individuals aren't going to receive that itemized deduction benefit, it might, if people are mobile enough and they aren't staying in those places for other reasons, if they can basically move out of the state and incur less tax and still have the kind of the same life and same, enjoy the same things, perhaps they, want to move out. So as they do that, if they did that and got, incurred a bunch of expenses to move, they used to, if they paid those out of pocket, they used to be able to take a tax return deduction. if an employer helped reimburse those types of expenses, the employer would get a deduction, and it wouldn't be included in that employee's compensation in their W-2. Now that the rules have changed, flip those things in their heads. Now, if you help employees with their moving expenses, you include it in their W-2s. And likewise, if an employee comes out of pocket for it, there is no deduction available. Believe it or not, there's still some questions we get about, improper treatment of employees as independent contractors. This mainly is spurred kind of by the employee base. They're trying to figure out ways to, put an entity between themselves and their employer so that they can take advantage of some of the business provisions potentially that are in the new tax act. Aside from the employee versus independent contractor rules of the Internal Revenue Code, all of you are likely well aware of the many provisions that situation goes against, from other regulators in the industry. So pretty black and white, especially in the tax area. I can't think of many instances that argue a set of fact pattern where an employee in a mortgage banking institution could be regarded as a contractor. W-2 reporting where compensation has been deferred improperly. The common occurrence here is, where commissions are banked, commissions or bonuses, what have you, are banked or stored until a later point in time when the employee decides to draw on them. And in the employee's mind, if I don't have the cash, they're not included in my W-2. I'm deferring, kind of taking my pay. That's still, believe it or not, pretty prevalent. We get questions on it all the time. That causes a lot of problems. If an employee has earned a wage, you must include it in the W-2. Otherwise, if they elected to defer it and not take it, it's your responsibility as an employer to report that amount that was improperly deferred to them, and you put it in a box on a W-2, I believe, that also states you're going to incur a 20% penalty. So employees are trying to save a few bucks by remaining in a lower tax bracket. That might save you, 2% or something. A lot of the tax brackets jump by. When in reality, if you don't avoid, getting caught, they're going to pay 20% more. So again, age-old issues in the industry, but just a renewed focus and importance due to tax reform. So really quickly, I know we're over time. I apologize. I'll wrap it up really quickly here. Just these are some potential other impacts to the industry on a macro level, I guess. Many economists predict decreases in property values, especially when the property value is high itself in comparison to others. And certainly double whammy when if a high property valued home is in a high property tax jurisdiction, those types of properties are definitely projected to decrease in value. On the flip side, the lower valued properties are expected to actually increase because in most situations, there's going to be more take-home pay for those individuals in the U.S. filing a tax return. So more cash at their disposal. So you might see finally some current non-homeowners come into the market. Changes to underwriting and analyzing a borrower's ability to repay. Pretty simply, one of the main documents used in underwriting is a tax return, and the tax returns are going to be changing quite a bit. So I don't know if this is a processing change or idealistic change, but certainly changes there. Jake started to allude to this earlier, and that it just relates to that standard deduction being more valuable than itemizing all your deductions. for a lot more people, that's going to be the case. I saw another study that just talked about, it was from Zillow, it just talked about home purchases in the last year and mortgages that dated back, as much data as they collect all the way back to that point. 44% of all mortgage borrowers had mortgage debt on a home that would have been enough to make sense for them to itemize. And Zillow's estimate under the tax reform is that only that 44% goes to 14%. So only 14% under the Tax Act will have mortgages big enough to make it make sense to itemize. So certainly borrowers are going to become increasingly indifferent to whether they get a mortgage interest deduction or not. Again, just reiterating, there's going to be more pressure to revise account structures, and those account structures might not comply with the various tax rules. Quickly, just mentioned it, more take-home pay for would-be first-time homebuyers, environment that might be conducive to individuals to move away from those high-cost urban areas. So if you're concentrated lending base in that area, you could see a negative impact there. Whereas if you lend more in rural areas, you may see some increase uptick. Just kind of overall thought is that the act itself, at least the individual provisions in it, probably has some positives, has some negatives. Overall, it's kind of viewed right now as a net negative, but it's pretty insignificant. Could have been a lot worse. There's a provision in both the House and Senate bill for the exclusion of gain on the sale of a home that didn't make it in, luckily. So I guess that's a net positive, I guess, if you consider that could have been worse. Just wanted to provide, lastly here, a couple of tools that are really cool. The top one that you see linked there is it'll basically take a set of facts and show you what tax you would have paid in 17, tax that same set of circumstances would have generated under the new Tax Act. Definitely not scientific, and probably there's situations it doesn't work, but really cool tool there. And then the other one is an article that kind of does that in it comes up with the facts and shows you the results for kind of 8 different family situations, and it even goes and tours around the country, weaving in and out of high cost areas and rural areas. So with that, let's wrap up, launch poll question 3, and we'll be done here shortly. All right, thank you everyone who hung around with us for a full 60 minutes. Sorry for running over a little bit there. If you have any questions at all, again, feel free to type them in the dialog box or reach out to Jake or I directly. As a reminder, we're going to launch a survey. Please let us know what your thoughts are, and we will continue to make this series and all future webinars just that much better if we get your feedback. Thank you very much, everyone.
Just real quick before we leave, just want to remind you that a recording of today's webinar and the slide deck will be emailed out to all of you, so do look for that either later today or most likely tomorrow. And those of you who did qualify for CPE, those certificates of completion will be sent out to you in the coming days, so look for those via email as well. Again, just want to thank you all for attending, and look forward to your survey answers and to joining us on future webinars. Thank you so much.